Okay, let's dive into this. You know, when you first look at a financial market chart, it can seem like, well, pure chaos, right? Just this jagged, unpredictable line bouncing all over the place. But what if I told you there's a structure, a kind of rhythm hidden inside all that noise? Today, we're going to decode one of the most fundamental patterns in technical analysis.
And it's a totally fair question. To the untrained eye, these price movements can look completely random. But what traders and analysts have learned over time is how to spot patterns that repeat themselves over and over again. Understanding these patterns, it's like learning the basic grammar of the market's language.
And here it is, probably the single best analogy to get us started. Just imagine the price is a rubber ball. It doesn't just fly off into space or drop through the ground, right? It tends to move within a room, contained by a floor below it and a ceiling above it.
So let's break that down a bit. When our bouncy ball hits the floor, all its downward momentum just stops, and it bounces right back up. And on the flip side, when it hits the ceiling, its upward push gets blocked and it turns back down. These two barriers, this floor and this ceiling, they are the key to absolutely everything we're talking about today.
So in market lingo, that floor has a name. It's called support. It's basically a price point where the buying pressure just gets so strong, it overwhelms any selling pressure. And if you think about the psychology here, it makes perfect sense. As prices fall to a level that investors previously saw as a bargain, all the buyers who felt they missed out, well, they jump in, creating this powerful zone of demand that, you guessed it, stops the price from falling any further.
And that ceiling we mentioned, that's called resistance. This is a price level where sellers overpower the buyers. The psychology is just the reverse. Traders who bought lower see a great chance to lock in their profits, while others who bought at this level before and lost money might just want to sell to get back to even. All this creates a wall of supply. And this brilliantly illustrates the constant tug of war between buyers and sellers that really defines any market.
Now, theory is one thing, but seeing is believing. The real magic of these concepts comes to life when you can actually spot them on a price chart. So let's take a look at how you can identify these zones for yourself.
So to find that support floor, you're looking for historical low points where the price has dropped but then turned around. When you see this happen multiple times, you can literally just connect those low points with a line. This is so powerful because we're using the past to give us clues about the future. That line becomes a potential zone where the price might just bounce again.
And finding the ceiling or resistance is the exact same idea, just flipped upside down. You scan the chart for those historical high points where the price rallied but then just couldn't push any higher. It hit a barrier and reversed. And just like with support, if you see it happen repeatedly, you connect those peaks. That line reveals the resistance zone, a potential area where the price might really struggle to break through in the future.
Okay, great. So you can now draw some lines on a chart. That's a huge first step. But the real question, the one you're probably asking, is how does this become a practical tool? How do traders turn these simple observations into an actual concrete strategy?
This is where the rubber really meets the road. This is where it all comes together. First, you identify the levels. Second, you plan your entry, maybe buying near that support floor. Third, and this part is absolutely crucial, you set your safety net. That's a stop-loss order just in case you're wrong. And fourth, you define your goal. You set a profit target, maybe right up near the resistance ceiling. You see? These levels give you a clear framework for managing both your risk and your potential reward.
And that right there is the main takeaway. These zones aren't just abstract ideas, they are active tools. They provide a logical foundation for making decisions, when to get in, where to put your safety net if you're wrong, and where to take your profits if you're right.
And just like that, you've pretty much grasped a core concept that traders all over the world use every single day. You've learned to see the hidden structure, those floors and ceilings that can govern so much of a market's movement. You can now look at a chart and see not just chaos, but a space with defined boundaries.
But of course, in the markets, nothing is permanent. These barriers are strong for sure, but they aren't unbreakable. A really powerful price move can shatter a support floor or just blast right through a resistance ceiling. So the final question I want to leave you with is this: what happens then? What does it signal when one of these long-standing barriers finally gives way? Well, that's a topic for another time.